Hello, everyone. Welcome to today's episode on finance, on personal finance. Today, I'm diving into a very interesting topic. Most of you already know, and that is budgeting. But before we dive into the topic, I just want you to know that you're hearing budgeting from an accountant. You're hearing budgeting from an MBA, and you are hearing budgeting from 21 years experience as an accountant. So so you're getting the best of the best for you to help you manage your personal finance, to help you plan your personal finance, to help you make sense of your personal finance. Okay, so let's dive into it. This is what I title budgeting personal finance or personal finance budgeting method in 10 minutes. And I hope at the end of the 10 minutes, you will get an immense value from this that can help you manage your money, that can help you plan your future, that can help you build wealth for you and for your family, and that can help you help do other charitable endeavors or pursuit or help out people in need. So let's dive into it. Today, as so you can see on my screen, the title is Personal Finance Budgeting Methods. I want to give you 5 budgeting methods that you can start using today to improve or to better your personal finance. Okay, so the number one method is a method derived in Italy by Pareto. It is called 80-20 principle. This 80-20 principle is being used widely in so many fields, both in marketing, in sales, in management, in organization performance, and in so many areas, so many professions. So, and I believe this will help you. I believe this is going to help you understand what it does. Because when Pareto discovered in Italy that 80% of the land, 100% of the land in Italy were owned by just 20% of people. 20% of the people own 80% of the land in Italy. And they decided to apply the same discovery into different areas, both in marketing, in manufacturing, and stuff like that. Which means your 20% output, your 20% should maximize or should give you your 80% output. And which means once you get your income, 20% should go straight to your savings or whatever you want to, to your investment, or to your emergency fund, or whatever fund you want to call it. But that is to you, that you pay yourself first. But we're coming to that. And the other 80% is for your expenses, for your wants, and beside your needs, your wants, and things like that. And so this principle, I've used this principle myself, and I've seen the benefit, I've seen the result, I've seen how it changed my life, from zero, that I had zero, to making 6, 7, 8 figures a year and owning different businesses. Okay? My case, my parents were not wealthy. They were not middle class. I had to work to pay my own undergraduate and my postgraduate. I paid for my accounting qualification myself. So you can see where I'm coming from. But today, I've been blessed that I could help people, okay, by applying these principles. And the next one we're going to go into, we've just spoken about Perotti principle, which is 80-20 principle. And the next one we're going to go into is the one that is popularly known as 50-30-20 principle. What does it say? Or what does it mean? It means that 50% of your income should go to your needs, and 20% of your income should go to your savings, and 30% of your income should go to your wants. Just the same thing as Perotti says, or that is also applicable with Perotti. But this one went a little bit further to break it down, to make it in a smaller chunk. Say 50% of your income should be for your expenses, so everything. Then 30% should be for your wants, because in economics we say that human wants are insatiable. It is something I learned when I was in high school, that human wants are insatiable. You can never. We all want the whole world. Even the billionaires and the trillionaires, they still want more. Even the richest country in the world, they still want more. And so our wants are insatiable, but at least this 30% goes to your wants, and 20% goes straight to your savings, which is to pay yourself first. But there's also a budgeting principle that says pay yourself first, which is what Robert Kiyosaki in his various books, for example, Rich Dad and Poor Dad, or Cash Flow Quadrant, or why they kept them poor, and things like that. So many books he's written, he's preached this principle. Pay yourself first. Because when you don't pay yourself first and you pay for everything first, you find at the end of the day you don't have anything left. So you have to break your budget down. But before you begin to apply each of these principles, first of all, you must have a plan. Is your plan? Are you going on vacation? Is it marriage? Is it investment? Is it buying another real estate property, or buying your home property? Or is it buying new clothes, new shoes, new wristwatch, new iPhone, or new Samsung, or new Galaxy, or whatever? Whatever it is, you must have a plan. It's after you have a plan, then you have to budget. Because when you begin to budget without a plan, it doesn't quite make much sense. Because, okay, I budget, I have this money. Okay, now let me begin to make a plan. You end up wasting that budget on something else. So first have a plan, and then you can appropriate or apportion your budgeting into those items on your plan. And now we'll move on to the next one, which is this is the one that Robert Kiyosaki have preached so much. Pay yourself first. If you listen to one of my videos, I also talked about this. When I talked about 10 habits that is keeping you poor, this is one of them, because you don't pay yourself first. Whenever you receive income from whatever means that income it came from, first thing, whether it be £1, $1, 1 Japanese yen, 1 Chinese yuan, 1 Indian rupees, or 1 naira, Nigerian money, or whatever, you name it all. Whatever money that is, whatever income that is, first thing you do as you receive it, whether it's a gift from somebody else, maybe a gift from your parents, from your spouse, from your mother, from your brother, from your sister, from whoever, or you win lottery or whatever, or from your business, from your job, your salary. Whenever you receive any money, the first thing you do is to pay yourself first. I'm not talking about going to buy clothes. Or I'm not talking about going to buy shoe first, or to buy makeup or eyebrow, or to buy eyeshadow, or to go buy new jeans, or to go buy new workout gear, or to go buy to change your car tire, to go get a new wheel. I mean, to go buy a new car or another car or whatever. That's not what I'm talking about. Pay yourself first. 20% or 10% should be to pay yourself first, which means take that money straight to your savings account. Straight. Then you've paid yourself first. And any other thing, and whatever that is remaining, then you can use that anyhow you want. But at least you've paid yourself first by saving 20%. It feels good when you pay yourself. It feels good that you look into your bank account, or you look into your savings account, or you feel good, oh, I put that money aside today. I mean, it feels good to know that you have money somewhere else. Okay? So remember that you must pay yourself first. And we'll move on to the fourth principle. And that is the principle I so much love so much, and that is zero-based budgeting. What does it mean? So zero-based budgeting, every single dollar of your income is assigned to a specific expense. It's not just when and this goes hand in hand, or this goes after you've planned. You're planning, and now the money comes in, your income comes in, or whatever that income is coming from. The first thing you do is if you're operating a zero budget method, you assign every dollar to an expense after you've planned, and after you've itemized, and after you've recognized and listed that expense. Whenever money comes in, you assign money, or every money you've got, you assign it into different items. Is it to pay off your credit card? Is it to pay off your mortgage? Is it to pay off your car loan? Is it to pay off your kids? To pay your kids at a nursery or kindergarten or high school or college fees? Or maybe you haven't bought a clothes this year. Maybe you just want to buy one pullover or whatever. Okay, you decide to get one pullover, or you want to get a pullover, or you want to get a shoe, or whatever it is. But you've already planned for that. You've assigned, and once you get money, you assign every single dollar you've received, or whenever you receive your money, into different items on your list. That is zero budget. It is very good, but also before you begin to do $0 budgeting, and this also includes, let me put it this way, this also includes you paying yourself first, because when every item on your list, you yourself is included on that list. So your name is in there, or your savings account, or your savings is in there, listed on that list. So whenever money comes in, you assign the amount that is due, the 20% amount that is due to your savings, you assign it immediately to your savings. So you assign every single dollar that you receive into an expense, or into an item on your list. That is called zero budgeting. Now, before I go into the last one, you must also understand that not one cap fits all. You have to choose what is best for you. What fits, what type of budgeting fits your purpose. It's not because somebody is operating on 80-20 or 50-30-20 or zero budgeting or pay yourself first, then you want to operate on that method. You have to choose what fits you, what suits you, what you can live with. Don't just go with the Joneses, because that won't serve you. You're doing yourself a disservice by doing that. You have to look at your own situation as an individual, as a person, and make a conscious decision, make a rational decision, and say, this is the method that suits me based on my current situation, based on my plan, on my plans, based on what I want to do, based on my needs, based on my wants, and based on what I want to do or where I'm going, where I see myself going. That's your future forecast. Okay? So you have to look at each and every single one of them and see what suits you and what is best for you. If that makes sense. Okay? Because when I lecture and when I teach people or when I show people about budgeting, and people always ask me what is the best budgeting method there is, and I always come back to this line by saying budgeting is not one cap fits all. You have to choose what suits you. You have to choose the method that suits your purpose, that suits your situation, that is best for you, that you can handle. It's not because somebody else or your friend or your partner or your mother, your father, or your cousin, or your nephew, or your niece, or your college mate or your colleagues or whatever is following or applying one method, then you want to do the same. Whereas your situations and your needs are not the same, your expenses are not the same, then you run into trouble. You will struggle and it will be stressful for you. Okay? And also, know that practice makes perfect. I don't expect you or anyone to start doing budgeting the first time and get it all figured out, all worked out, all perfectly. In an ideal world, that's what you want, but you have to start from somewhere. You have to start and you have to practice. You have to practice and practice and practice. And as you remain consistent applying that, you become an expert and you begin to work out the way you want it. If that makes sense. And that takes me to the last budgeting method, which is envelope method. Now, in this envelope method budgeting, you put a specific amount. This is what my granddad used to do, or the older generation before my father, the older generation, what they used to do was they put money every month. My granddad, my granddad always put money every month in an envelope. Instead of put it under his pillow or put the money under his bed. He has a special box. He used to say, I must put. This is where I always put my money. Granddad, why didn't you put your money in the bank? Because somehow he didn't trust any bank, or they didn't even have access to bank. So what he did was, after when he gained all that money, he would count it, him and his wife, and now they would put it in a box and lock it. They put it in different envelopes in a box and lock it. And what my granddad did so well is that, in every envelope, he would name it. We say, this is for this is for that, this envelope is for this, that envelope is for that, that envelope is for that. It's so the man was so good. So yeah, so that is how. But now we have we've been given the opportunity and the possibility to use mobile apps to do it. So you can easily use mobile app once you receive your income from your bank. Take 20% or whatever, or 10% straight to your savings. This is how envelope method works. And it's physically, you move your cash or electronically or with spreadsheet or whatever method you use. is very straightforward. So folks, we've come to the end of different types of budgeting. As you can see, we've gone through this was our main topic. This is our main the starting point. And now we went on to discuss about, in brief, the first budgeting method, which is 80-20 Pareto principle. Now went on to discuss the second method, which is 50-30-20, and went on to discuss pay yourself first method, and I also talked about zero-based budgeting, and I went on to also discuss about envelope method. I hope you've gained something from this video, and if you have, please do me a favor to subscribe using the link below or using the subscription button below. Subscribe to this channel and hit that notification bell. Also share this link to your friends, to your family, to your colleagues, to whoever you think that will benefit from this video, because every week I'm dropping video just for you, to help you manage your finances, to help you manage your money, to help you become the best you could possibly be, and to help you achieve that goal, that dream of yours, that financial independence or financial freedom that you deserve, that you desire, that you want. Okay? Until next time, stay blessed and keep safe.